still adding people on. But yeah. All right. With that being said, Jason, 5 minutes.
Thanks, Malik. We'll try and keep it at 5 minutes today. That might prove impossible. You guys let me know if you're seeing and hearing okay, please.
Loud and clear.
Yes.
Awesome.
Yeah.
All right, guys. So to get rid of the elephant in the room first, let's talk about this. Now, these festivities happened today, and that's why this is kind of just stuck together. But what I will do, hopefully not to upstage that link, well, that did not go as planned. I'm going to send that link in the chat, and you guys can go and look at those statements yourself. So the unaudited quarterlies were released for carb cement today, and it has been a fiasco in the markets. Victoria, you want to elaborate on that for us?
Okay, sure. So guys, if you follow the market or not, you might have known or seen that carb cement quarterly financials came out. So for those who are new, just really quick, each quarter companies have to release their financial statements. You're a shareholder, you have to know what's going on. So guys, everybody's seeing construction booming all around Kingston, right? So we're thinking, okay, they're making a lot of money. Only to see this morning that they had a 1.8 billion fall in revenue. 1.8 billion with a B, guys. So as you can see, that really shocked the market. You see where Jason is pointing, that is today alone. It was a huge shocker. So you want to say what happened, Jason?
So basically a lot of stuff happened. If you guys are looking at that report now, I think that takes you to Jamaica Stock Exchange, and then you have to click on that PDF. So it's not, no, that's a direct link because it ends in that PDF. So what happens? Their quarter on quarter went down. So you have different quarters. A year has 12 months. You divide it by 4, you have 3 months. So their 3-month period that ended in September had a really big fall in net profit. What was that, over 96%? Or am I telling the right number? Yeah. So people got crazy, because if you buying a stock means you own a company, you own a share of a company. That's why we call them shares. Like your share of a pizza or your share of a pie, that's your share of a company. So if the company loses profit, you lose profits, and people don't like that. So you want to get rid of the things that make you lose profit and probably put the money somewhere else. And that's why we saw this. So this was between 110 and 120. I think this was like 115 or 16 point something. And it fell down to like 102 in one day. In one day, that's crazy. So they were saying that the weather conditions were hampering construction as well as hampering their production, I think, because, you know, you don't want cement to get wet before it's supposed to get wet. So they said that that was a big deal. Now, where I am skeptical about that, and more optimistic persons like Victoria might disagree or like have their conjectures, is that their accounts receivables were really high. High accounts receivables mean that you're not collecting money that people owe you, right? So that means your management is not being as efficient as you'd like. And then their inventories were huge. The inventories could be huge because people just weren't buying cement because it was raining and they didn't have need for it because their construction was gone. Or maybe they're producing more than they need in this term, which is probably wrong because they had a shortage and had to be imported, like Matthew was saying. So we could stay and talk about this all day, but we've got to move on. We have anything anybody wants to add about this?
Yeah, well, really quick before you move on, Jason, I just want to say, some of you guys have been really on the ball as new investors and seeing that a dip is a buying opportunity. This is not me telling you to go buy carrot cement. I'm not giving financial advice, but as an investor, you have to think for opportunities and look for what's out there, guys. So Carib Cement is a solid company. So if you look at their financial reports over history and see something that you like, you notice a good trend. If you look all around and you see construction everywhere, cement is needed. So if you think it's a good opportunity, you could take it because it might stay down for only so long. A lot of people are diving in, so take that as you will, guys.
We'll see how it goes. All right, so another elephant in the room. Let's go step by step with this. I stole some of what Victoria had on Instagram because it made my life easier. So, but let's start off with the press release from, what was the Siboney? So Siboney, guys, we've been tracking this company for months, like even from the last academic year. So let's look at what they recently published. This was like just now. The directors of Siboney Group Limited, blah, 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 are advertising the red box purchase of its entire 72% shareholding. When someone wants to sell so much of something at one time, it raises questions. So why would that be a thing, especially when almost no one knows what Siboney does or what whoever is trying to buy them out wants to do with them? So let's go on. When this offer was made, they're saying, oh, well, maybe I can get it at a steal and let's just get that money and sell it off. And this is what happened between, let's call this October 11th and like recently. Now, Victoria was saying, when was this? I don't remember when this was, but this was recently when the market started to pick up. I hope I got the order of them right because I forgot where they were. But you guys know a circuit breaker is triggered when a market goes, was it 15 or 20%? I don't remember.
15, yeah.
15. So if you have a change, it doesn't matter if it goes up or down, but if you have a change of more than 15%, is it an hour or is it a day, a certain time period, then that makes the market very volatile, meaning it's going like this, and you don't want a market like that. So they stop trading for a certain time. And if you have a circuit breaker basically within an hour of the market opening, that means people are really into that stock for whatever reason. So this is Victoria tracking it on Instagram. Let's go on further on. So yeah, here it's just been going up. It halted at over a quarter. Like, okay, so you start out with 1, you have 1 1/4 of that value. That happened within an hour of the market. So when we see that rocket, kind of like what GameStop was saying, going to the moon, what goes up almost always comes down.
Exactly.
That's what we see right there. So you see over 30% going down. It goes up 25, but falls 30 plus. And this is the inherent volatility of the markets. And that's why we have to be careful and have to be wise and not invest out of greed and fear and pure emotions. But we do our analysis and know if it's a good company, as well as the technical analysis. Even if it's a good company, you'll still lose money if nobody else thinks
exactly.
So
Guys,
that's what we learn here.
Yeah, this is an example of a really risky stock. So I've heard a lot of stories about people making so much money from Siboney, because if you've seen it in the past year or so, as we've been tracking it, it's gone up like 1,000% back in 2020. And then it trended right back down. As Jason said, what goes up must come down. So it's
always comes down.
Yeah, almost always. Yeah. So it's really crazy because you can either lose a lot or you can gain a lot, but it's extremely risky. So you have to know what you're doing. But yeah,
just to add to what Victoria said, Siboney, like, it blew up about this spring and it ran by like 2,000 or like 1,000 something %. And I remember it moving from like 30 cents all the way past $2.20. And it just sank. And it sank because one person, just like Caribbean Cement today, one person made a sell order that was so low that it just pulled the whole thing down. But yeah.
It's like
we didn't talk about that with Carib Cement. Like Carib Cement, well, the order didn't go through, right? But somebody wanted like 1.2 million worth of stock to just get sold at that. Yeah, so the price up here, where's my laser pointer? $81 is down here. So if somebody is getting $1.2 million worth of stock, that it should be here instead of here, not only is that a big bet, but it's a big bet to make other people consider their bets. And that makes markets. We don't want that. So, well, it didn't go through, and that's probably better for, what we call in econ, total welfare in society. But for that person, I don't know why you're shorting your own game.
Exactly.
Moving on though. So Digital, this is sort of Jamaica news. They have a roughly $1.85 billion US deal to sell their Digital South Pacific operations. This is relevant to us because Digital was kind of-ish bankrupt, kind-of-ish lately. And hopefully this would add more liquidity and cut back on their expenses. Now, if you're wondering where all of these long names are, just look at where's in red. Where's in green was where they were supposed to expand to. This is about 6 years ago, but I really don't know what happened. Like, even though those numbers are more than 6 years ago, the green was put 6 years ago. So that's just fair reference point in relation to Australia. Two stuff. So Capreet, we had the CEO here earlier this year, really bright guy. And he and his company, they acquired this new Crossroads area to be developed. They haven't had an IPO yet, have they? Because weren't they supposed to, like, recently?
An APO.
They're supposed to have an APO.
There was an APO. Okay.
It's still it's at the regulators, if I remember correctly.
Okay. So I've been looking out for it because, I mean, again, not investment advice, but in my lay person's opinion, it's quite a good buy. Yeah. I don't know what price they'd be offering it at, but I just think it's a solid company.
Was not investment advice. Buyback that they were also considering?
With that few shares out? Like in the general public, with that few shares out in the general public? I thought that was JMMB. I don't know about Capri doing it. Maybe they did, and I don't know. But
oh no, I think I'm mixing it up. It was back when they mentioned something was gonna happen, but people weren't sure if it would be a share buyback or an APO. But I think an APO is in the works, and as Matthew said, it is in the works. So we'll see.
Okay, cool. Next thing, Norbrook and JP. JP is the banana company, Jamaica producers. Well, they do more than bananas. They made this Domrep acquisition. So Norbrook Equity Partners owns a lot of places like Mailpack, Express Fitness, places that we know they're the holders for them. And they had this 50-50 partnership to go into the Dominican Republic. I don't know why for ice and water. Clearly these people know about money and would do it if it's profitable, but you know, the public doesn't have much information about that. So we'll just have to see what happens. We're moving on because we're running out of time. Hugo, so these guys who like to, I just think it's ridiculous when you have such a big thing on the back of a motorcycle because the people can't maneuver properly and they're already not known to be the most responsible drivers, right? But they got bought out by this German company. What's that called? I can't see it on my screen because of how it is delivered here. Yeah, so they operate in Central America and the Caribbean. I was shocked about Central America because they do stuff in like Guatemala, if I'm not mistaken, where I'm told if you're relatively well off to afford to use Hugo because, well, even though the partnership is different, sometimes these food delivery costs cost more than the food you're trying to deliver. And income inequality is so big there that the well-to-do people often need armed guards only to leave their house. So how is it that these bike people stay safe? I don't know, but I'm not speaking from complete information. Jamaica, our capital is short and people are expecting inflation. 4.17% instead of 3.28% just so quickly. That is crazy. So somebody was asking me today, do you think that the Jamaican housing market is going to cool down because the mortgages are going to be more expensive? And I just don't know yet. I think it's going to take a little while before we see the consumer behavior being reflected in prices. But that's pretty interesting. Higher interest rates means people and investors in particular are holding a government accountable. So we'll see what happens. This is a pick to keep you guys going since some of us still have mid-semesters. Don't fall into this trap. World. So another thing was that Carib Cement was having to import cement, right? Because apparently there was a shortage. And that I was telling Matthew earlier today that I think it has to do with the supply chain. That's not just a Jamaican, by the way, this is me speculating. I don't have proof that it's a supply chain, but we know that this has been happening recently. And the WTO signals into shipping prices. I don't really see why they'd say so. As in, I'm not saying I know more than them, but based on what they were saying, like, oh, people are expanding capacity and more ships backing up like this. All of these stuff that you're seeing are ships. This is in Los Angeles, so that's one of the biggest ports. Los Angeles is one of the biggest ports because it's across the Pacific from China, and China is one of the biggest exporters. And California, despite everything there, has a lot of filthy rich people, so they're a big importer. And that's what happens when you have a supply chain issue. So this is you guys see prices like being yo-yoed way more than usual, and this is part of why. So it's not just that lots of people importing because you have that pandemic kind of slinky or yo-yo. Like, okay, people were holding back and now let's spend, but you don't have enough truck drivers to take the things off the ports. And that's a problem both in the US and the UK, till, they're even making memes about going out and about to find immigrants and saying, any of you a truck driver, come. So, yeah, that's pretty interesting. Do we have one more picture? And I think that's my time to go. Yes. So about this supply chain, about prices going crazy. Inflation has been so rampant. So at the 4th of July, a certain entity, I'm not calling any name, worse because this is being streamed to YouTube and would probably get censored. They had said, supporting a certain administration, that their policies brought prices down, and this was said in July. So they were saying the 4th of July cookout in the US would be so much cheaper than before. Thanksgiving 2021, so this is like November-ish, I think, the most expensive meal in the history of the holiday, because the US economy, this is a supposedly developed economy. Target inflation is usually around 2%. We can argue why it should be 2% and not 0 or less, but they say 2%, fine, it's at 5.4. If you have savings and you hold them for 13 years at that interest, at that inflation rate, the value is halved. So what 100K can buy now in savings, you leave that for 13 years, which is younger than basically all of us, the value is halved. That's not good. So we'll see. But do we have any time to take any inputs? Basically, one, if anybody has. No? Okay, well, guys, thanks for your attention. Again, a very interesting week. And I will now turn over to Matthew to introduce our guest speaker.
Actually, we're going to allow Joshua from Rotaract to say a few words to his club members.
Yeah, all right. Good afternoon, guys. Thank you for having us. Thank you to President Ali for inviting us and being so courteous. So just to make a few announcements for my club before we move on. So as you guys realize, this month is Economic and Community Development Month. So we're here, you guys should listen out. One of Rotary's big areas of focus is economic and community development. And this involves us promoting economic and community development, improving access to finance. So you guys getting an understanding of investment, owning something for yourself, etc. is very, very important. So I urge you guys to listen, to learn something new, and to just have a good time. Other things that I need you to know about, we have some services coming up, and I really, really, really need you guys to attend our services because I need you to attend the services. We try hard to ensure that you have services to do. So where there are services, I'm gonna ask you to go. If you have a problem going, or if you need anything, if you have any question, concern, comment, let me know. My WhatsApp is open. Remember that there's a service down at Bethel. It happens 5 days a week. So you can go ahead and attend. Just let me know that you're going. We also have a tree planting coming up on Saturday. Registration for that is closed now, but yeah, in whatever way that you can support, just let me know. And lastly, we're having a beach cleanup on the 13th. I think we have now pretty much confirmed that we're having a beach cleanup on the 13th of November, so you can start thinking about if you can go. It will be at Port Henderson Beach in Portmore in coordination with a whole heap of people. So we will get it done. I hope to see you guys, especially ones I don't see and I don't know, because enough of day night club, I may never yet see you. So I would like to see you guys come out, although numbers should be limited. But as I said, think about if you can go and let me know as soon as possible if you want to. So that's it for me. All right. Yeah. Thank you.
Okay. Thank you, Joshua. And we're happy to have you. So I'm just going to hand over to Matthew now.
Hi, everyone. Our guest speaker today. Are you hearing me, by the way? Okay. Our guest speaker today is Mr. Marc Gale. So Marc loves complex systems. Having completed his MBA in finance and a BA in computer science in Florida, Marc returned home to Jamaica and its tech community. He enjoys helping entrepreneurs build their dreams into empires, while he and his two business partners built their own company, TCP Things. If you've ever been to Fontana, you've most likely seen their products. So in his 2 decades of multifaceted finance experience, he cultivated the ability to break down complex systems into understandable chunks and put them into plain language. He has also applied this to writing, having contributed software development and finance pieces to various renowned outlets. He is known for leveraging these skills towards the social media movement, #FinanceTwitterJA, that helps to raise financial literacy and democratize wealth building and knowledge and personal finance development. Mr. Marc Gale, welcome to the UWI Young Investor Club Interclubbing with the Rotaract Club. Thanks for taking this time to speak to us today.
Thank you for having me, Matthew, and everybody else here. I must say that I'm very heartened with. How long has the Young Investors Club been around? Can anybody tell me?
About from 2011.
2011. Okay.
Yeah, about a decade.
All right, cool. I mean, that I'm very, very heartened by that. I'm happy that you guys are taking this seriously. I wish I had, a club like this when I was your age, to be very honest. So don't take it for granted. That's I guess the overall thing there.
Okay, so Mr. Gale, we have a couple questions for
You
you.
can call me Mark. I'm not that old. Please, Mr.
Okay,
Gale.
Mark.
Yes, thank you.
Okay, fine. So Mark, we have a lot of questions for you, and we really want to cover a range of topics. So we hope that everyone is here listening, everyone is taking advantage of this opportunity to just get some more information in your head. So we want to know, the first question is, were you always this attentive to your finances, or was there this aha moment that you were like, oh, I need to pay attention to this?
So I wasn't always, as attentive to finance as I am today. But I have, as long as I can recall, I've always wanted to, build my own business, run my own business, and acquire wealth. And over time, once I started to take the wealth acquisition strategy seriously, I studied it and I realized, like, if you look at the list of the wealthiest people in the world, the only common denominator among all of them is that they all own a big chunk of a company, either a big chunk of a decent sized company or a small chunk of a very, very big company. But ultimately, what it boils down to is that they all own equity, and very, very valuable equity. And, a lot of them, they own that equity because they built the company, right? So basically through entrepreneurship, you're talking about, obviously Bill Gates, Jeff Bezos with Amazon, Elon Musk with Tesla and SpaceX, and the Walton family. And the Walton family is a classic example. That was the first aha moment for me, where, maybe like 20 years ago or something, I looked at the Forbes list and I saw that, the list of the richest people in the world from 5 to 10 were all Walton. And I was like, what happened here? Like, this is so weird. Turns out that Sam Walton, the founder of Walmart, he died, and then he equally distributed his estate among all his wife and his kids. And so all of them were worth the same amount. At the time, I think it was like $20 billion each. And so all of them were like tied for 5th place, or, 5th, 6th, 7th, 8th, 9th, or something like that. And so that just, kind of like demonstrated to me how powerful equity ownership in a valuable company is, and how powerful entrepreneurship is. So ever since that, I kind of, took it a lot more seriously.
I see here that you have a computer science degree, like myself, or what I'm studying for, and I'm a Spanish minor. So one would say that this background wasn't quite into finance investing. So I want to ask you that, did your aha moment happen during university, or did it happen how long after? How did you make that kind of transition to what you started up from what you studied?
And you're talking about from the finance perspective, right?
That's right. So you had a certain background, and yet you had this interest.
Right.
So when was your aha moment? Like, when did you notice when in life?
So when I was growing up, I knew I always wanted to build a company, and I've always, had a natural inclination towards technology. And so I kind of figured that because I love business generally, and I will do business and study business without, needing to, I figured it's better for me to, just get my formal degree in computer science. So I knew I've always wanted to get into business in a real way. I did my undergrad. I actually started off at UTech. My parents, I feel bad for them because they always say, it's the most, expensive party years that they've ever paid for in their life. Completely wasted my time, flunked out of UTech, basically. By God's grace, I got a scholarship to go to college in Florida. And then I took my school seriously and did it. Then after that, about a year after I graduated, I did my MBA. And while I was, doing my MBA, that's when everything clicked. I learned about economics, macroeconomics specifically. I did some accounting in my undergrad, and I really, really liked it. So I knew that, okay, I want to do this. But it was really in my MBA once I started to understand the way the world really works, not the way that people tell me it works, that's when I haven't been back since. I haven't looked back since, and like I realized that once the wealthiest people in the world are the people that understand finance and understand how to leverage money in different ways, either leveraging the capital markets or whatever, and so it was really my MBA that cemented that for me and kind of like changed my worldview. But I always knew I wanted to get into business, which is why I went and did my MBA in the first place.
Got you. Thanks. I really like to hear that experience because, I'm studying CS and want to know how to use it. I'd love to come back
and
to
by the way, sorry, one quick thing, in terms of like investing. So I really kind of developed my love for investing. I think while I was doing my undergrad, actually, I started investing or trading currencies. And this is while I was in the US. And this was in the lead up to the 2008 financial crisis. And
wow.
Yeah, so I traded, going probably about 2 years, going into that and then through the crisis. And that was, brutal, made some good money, lost a whole heap of money, all these different things. But it kind of, taught me, gave me a solid, foundation for like technical analysis and, how the economic indicators work, how they move markets, that sort of stuff. So that really kind of like whet my appetite for investing generally, as this is outside of entrepreneurship and financial analysis of companies and all that stuff.
I'd really love to get back to the investing and entrepreneurship because we have some questions on those later. But since this is a personal finance session and since you went abroad at a relatively young age, I wanted to ask you about budgeting. So first question, how would you describe budgeting? What is it and how important would you say it is?
So, budgeting is simply, planning in advance, how much money you're expecting to make over a time period and how you're going to allocate that money, right? And so, because if you don't do anything with it, money has a way of just going, of being used or being allocated, whether or not you allocate it intentionally or not, right? And so I think budgeting is extremely important. I think that's a fundamental skill that every single person should master. If you don't know how to budget, you're really flying blind in terms of with your personal finance. You don't know, you're wasting a lot of money or you're spending a lot of money and you don't even realize it, right? And so you can't really build wealth if you don't really know how to budget, in my view.
Okay, so since a lot of persons don't know how to budget, what do you think is a good base way for persons to actually divide their income to also include investments?
Right. So the way I think about this is, the obvious thing is, you can start off with a spreadsheet, and I know that may be daunting for some people, but you don't even have to start there. You can start off with a pen and paper, and you just write, okay, I'm expecting. So let's say you do it on a monthly basis. For the upcoming month, I'm expecting to earn, X amount of money, $10,000, $100,000, $1 million, whatever. And then you literally just itemize, all right, from this money, this is what I'm going to put. I'm going to put, you write down all the categories, all the bills you have to pay, all the things that you want to do, your investments, savings. I also do a thing called miscellaneous. So, because you don't really know, things always come up every single month. You want to allocate a certain amount of your budget to that so that you can, so you're not dipping into other things. But even more basic than that, and especially when you're just starting off, there's a method that I use that I absolutely love, that I advocate. It's called an envelope system. I don't know if you guys are familiar, but literally what it is, I think in this day and age it may be a little bit harder because you use card to do everything. But basically, literally what you do is that you withdraw cash and then you basically get a bunch of envelopes, and then on every single envelope you write down the allocation, right? So again, thinking through, let's say you have 15 different categories, your light bill, water bill, gas, or bus fare, or, food, lunch money, groceries, all these different things, right? And you want to itemize and break them down as much as possible. You basically just get a bunch of envelopes and you write each one on each envelope, right? So each category on each envelope. So you would ultimately have one category per expense item. And then, you withdraw the cash and you put the cash in there. Now, obviously, in this day and age, if you pay your bills online, for example, you can leave like your light bill and, those things, in your bank account, and then you can just, pay them online. But if you really want to be disciplined, you want to take out as much as you can, put them in all of the envelopes, and then you spend out of the envelopes. And what I think what that really does is that it forces you to understand the trade-offs of your spending decisions. So for example, if you have an envelope for eating out, and then you have another envelope for groceries. If you eat out, if you spend off all of your eating out money, right? Because you eat out, let's say you're 7 days into the month and you've eaten out every single day for the month, but you only budgeted for 7 days worth of eating out. You are then, forced to choose, all right, I'm either going to take money from gas or from bus fare or from groceries or from something else. So it shows you, and it really forces you to think through every single decision. And I think that habit of understanding that every single dollar that you spend is a trade-off. You are not spending it elsewhere, or you're not saving it, or you're not investing it. That is the most important skill or takeaway from the envelope system. So I did that for years upon years. Even after I got married, we did it for probably like 5 or 6 years. Like, I absolutely love that method. And so, yeah, I advocate that for everybody.
Yeah, I never thought of it that way because, again, as you said, we're in a world with cards. So the next question we wanted to ask you, but I think you kind of addressed that. How strictly would you suggest that someone track their spending? So maybe, would you recommend you give a margin of error? And in addition to the envelope system, which is a lot more, paper tangible, in this digital world, is there any tool that you'd recommend that might be more, Gen Z friendly that, you think would be helpful?
So if we're living in the US, there are a bunch of tools, that kind of mimic the envelope system in the US that kind of work with your bank account. Unfortunately, we don't have, I don't know of any tools. If anybody knows of any tools that will mimic the envelope system locally, work with your local bank account, then, feel free to share. I haven't come across any. So I don't really know any like that. The only thing I would say is your spreadsheet. So adhering to your budget, I think, is extremely important. If you don't adhere to the budget, then it defeats the whole purpose, right? So you're just fooling yourself and doing a useless intellectual exercise that is a waste of time. But yes, that's kind of, those are my thoughts on that.
Okay, so we'd also like to know, what are your views on debt? So like house and car loans along with credit cards. And is this something that you think we should avoid, or is it something that we should use wisely?
Yeah, I think with everything, debt is a tool, right? So it can be good and it can be bad. You definitely should not use it to consume above your means, right? So if you're only earning, $50,000 a month, $100,000 a month, even $1 million a month, if you're earning $1 million a month, do not use debt to spend $1.2 million a month. That makes no sense, right? So that's a general principle. It doesn't matter how much you earn. It really is about how much you keep. So, that being said, you can use, debt, sometimes for large purchases. So like home, if you want to buy a home, for example, or even a car, right? One of the things with a car, for example, if you can, well, this is just my view. My view is, I personally prefer to buy a newer car because I can't bother deal with the maintenance. That being said, if you buy a brand new car, as in like a current year, you're going to deal with the instant depreciation hit as soon as you drive the car off the lot. If you were to drive it home and then take it back to the dealership the next day, to sell it back to them, the most you could sell it back to them is maybe like 85% of what you bought it for, literally the previous day, right? Or 90% or something. So given that is, so that action or the loss of value is called depreciation. So in my view, I think it's better if you buy, a car that is, 1 or 2 years or 3 years behind. Now, obviously, again, this isn't an ideal case. This assumes that you have the income to support it and it doesn't consume too much of your income. But yeah, so I would say, so credit cards, as I said, it's a tool. Like you can use you can use debt to either help you accumulate wealth when you want to buy a house, to obviously make your life, your quality of living better. So it does depend, but the underlying principle is, do not use it as a tool to consume more than you make, and even don't use it as a you don't want to be spending 50% of your income servicing debt. Like that's not a great it's not a great place to be, especially in the early days. Maybe when you're older and your mortgage is 25-30% of your income, sure, you may be in that situation, but especially when you're young, like just try to keep it as minimum as you can.
Okay, so as aspiring homeowners, what advice would you give to us in regards to mortgages and NHT?
Okay, so I am a little contrarian when it comes to home ownership. I think that obviously all of the benefits of home ownership. Typically speaking, generally speaking, real estate as an asset class tends to increase in value, especially in Jamaica over time. That being said, there are no guarantees. But one of the things that I think a lot of people don't talk about enough, especially to young people, is when you buy a home. Yes, you are kind of starting the process of wealth accumulation, because you're hoping that the equity increases over time in your home as the value increases. What people don't talk about is the optionality that you give up, right? So one of the downsides to owning a home is that once you buy the home, you have the face value, right, of whatever you pay for it and the closing costs and all that stuff. Then all of a sudden you're gonna have to deal with like all the things that were broken that the seller forgot to tell you, right? So you're gonna have to dip in your pocket and deal with all that stuff. Sure, you can budget for some of that, but even outside of that, if you are let's say you buy a house in Kingston, for example, and then you get a wicked job offer in Mobay, what you gonna do? Then now all of a sudden, so let us say that the salary is 3 times what you're currently making in Kingston. It's not like then you have to think about, okay, now I have to go through the process of selling. Some people get stuck, right? So that's the optionality I'm talking about. Like when you buy a home, it is a lot harder for you to pick up stakes and move, which is more costly from an opportunity cost perspective when you are younger. When you have a family and you want stability, that's one thing. Then I guess you can make an argument for that, and it's more appropriate then. But as a young person, what you're trying to do is optimize your income as much as possible. And that may mean, or, that will mean that you probably have to look for jobs wherever. It could be in the US, it could be in Canada, it could be in Mobay, it could be in Ochi. You never know, right? And so if you buy a house right out of college or out of university, you are basically saying that I am betting that I'm not going to want to leave this area for the next, 10-15 years, right? Because once you have to sell, that's a whole process you have to go through. Like as tedious as it was to buy, sometimes it's worse on the sell side, right? So that's something I think a lot of people don't talk about. So I would recommend, even though some people say, oh no, when you rent, you're just throwing away money or whatever. I don't view it as that. I view it as I'm just paying for optionality. That is the way I view it. And so to me, optionality, the ability to be able to go wherever I want, break my rent, and give up a 1 month security deposit, is a much better use of my resources, because I know that, okay, if I get a job offer in Silicon Valley, or I can go and start a company in Silicon Valley or whatever, I can just get up and leave. I don't have to, I just give up the 1 month's rent as opposed to having to think about selling my house.
We have a question in the chat from it's saying, how about buying a home for the purpose of renting it? Does that leave you stuck? Okay,
so that's a lot better. The thing is though that that also comes with, if you've never done it before, there is a learning curve there, right? So that can also be a distraction. The payback period also can be long, so you really do have to ask yourself, all right, so suppose, for example, the person skips out on rent, for a month or 2 months, you have to cover the mortgage. I'm assuming that you're taking out a mortgage to be able to do that, right? So you are on the hook for the mortgage. So if you get a great tenant and you can raise prices on them at the rate of inflation every single year or every 2 years or whatever, then sure, that can be a great thing. But if you get a horrible tenant, you have to deal with the mortgage, and then you have to deal with your rent or wherever you are staying, and then you have to deal with any issues that come up with having a horrible tenant. If they buck up your place, and if you have to, like, I know of people that have had to sue, like take their tenant to court to get them to leave. Like, it's crazy. It's not. So again, I'm not saying that every case is like this. On the flip side, I also know of people that own properties and them some at bank, right? They just put on Airbnb, and people come in, and a lot of their Airbnb visitors have been great. So the experience can go either way. So it just really depends on your restaurants. It depends on your income. I would say, you want to make sure that you have enough buffer in your monthly budget to afford carrying an extra mortgage, for a couple months, in the event that worst case scenario happens, and you have to, evict the tenant, and you can't get another tenant and all that stuff. So if those conditions are true for you, then sure.
Some of the things that you just said sparked memory of this video on Khan Academy that was looking at the opportunity cost of renting versus buying. And he was making a very similar argument to you that renting is paying for optionality. So I'm just going to link that video for whoever wants to copy it and watch it later. And secondly, when we're talking about credit, so any form of debt, this could be credit cards, it could be mortgages, it could even be a car loan, whichever that you, however you call that. When it's within the person's means, would you consider that a tool for managing personal finance?
I think it can be. So for example, you can use. All right. So once it's within your means and you're able to clear the balance in a month or a few months, realistically, like, don't delude yourself and say, okay, yes, I'm going to pay it off in 3 months, and then really and truly you're carrying this thing for 5 years, right? Like, so if you're going to delude yourself, and you have to be honest with yourself, you can't, like, what you need to understand is there is a reason that banks push credit cards, right? And it's not because they know that you're going to be disciplined. It's because they're banking on the fact that you are not going to be disciplined, and it is very, very lucrative to them for you when you are not disciplined, right? So keep that in the back of their mind, because banks are profit-seeking entities, which is there's nothing wrong with it. I'm just stating the facts. That being said, if you genuinely can be disciplined, there is something to be said about, getting a good credit card that has, great points, for example, that you can use for travel. Putting some of your expenses on your card and clearing it off every single month, so you can accumulate those points and you can travel for free as you do that. Now, I know that that's a very, very popular strategy, and that can work, really, really well. But again, it's a double-edged sword, and I'm saying this. So right now I'm speaking on a MacBook that I bought probably about 10 or 12 years ago. And I always use it as an example because this is my $10,000 MacBook, right? Which is insane, right? Like, who the hell buys a MacBook for $10,000? Well, obviously I didn't buy it for $10,000, but I put on my credit card and I said, oh yeah, man, I could clear this off in a year or whatever at the time. And one thing after another, life happens, and then it just drag on longer. And then one day I actually sat down, like when I actually paid it off, I sat down and I just calculated it, and it worked out to be like almost $10,000. I'm just like, yo, a $2,000 purchase, or turning, or a $2,500 purchase turning $10,000 over a couple of years, like, it hurt me. So, and again, I was very financially literate and whatever. So I'm saying all this to say that not because you know it in your head, means, and I was doing the budget, the envelope system and whatever, right? So I'm telling you all of this not to cast judgment on, anybody that that gets caught in the trap. I am saying that the trap is so powerful. You want to be careful. There's a reason that people like Dave Ramsey and all these guys tell you to just cut up credit cards and don't use them at all. I think that's a bit extreme, but I'm just, just be careful.
Okay.
I believe Victoria had a question. Yeah.
Oh yeah. There was a question in the chat about how does it benefit the bank if we're disciplined? Could you give some insight into that?
Yeah. So to be honest, it doesn't really benefit the bank too much if you are disciplined. Well, so the Jamaican banks, it doesn't really benefit them more than so if you are disciplined or indisciplined. Okay. Yeah. So if you're indisciplined, I mean, it benefits them because you're paying interest, right? So the average interest rate on a credit card is like 40% a year, right? So for example, so if you put $100,000 on your card, just in interest alone, you're paying them 40 grand a year. I mean, they love that. They absolutely love that, right? And in some cards, do have annual fees and whatever, but that the fee income that they make on credit cards is really nominal relative to the interest charges and late fees and whatever penalties and overdraft fees and all these different things that are related to either missing a payment, paying late, paying below the minimum balance, or even just paying the minimum balance. Like all these different, there are so many different ways them can juke you, right? So yeah, that's how they benefit by just sticking the average APR at 40%. That is the bare minimum. If you trigger certain clauses, sometimes that doubles or triples. So you have to be very careful. If you're disciplined though, you don't really they don't really benefit other than mining your data, but I don't really know how much the local banks do that. So
Marc, I have another question on the note of debt and on talking about mortgages. This is a financial literacy chat. A lot of us don't learn about mortgages in school. So can you give us some insight into how this works? So for NHT, we have in Jamaica, for example, I think you can borrow up to 6 million at a rate of 4.5%, which is really good because banks offer like 7%. You can double your mortgage. Yeah, can you give us some info on that?
Yeah. Okay. Honestly, the best person to talk about this is really Miss Jilly J. Jillian Jackson from Twitter. Huh?
I'll share her handle.
Oh yeah, right. Okay, right. So yeah, David can share the information. But okay. So generally speaking, just at a high level, the way the mortgage works is, you go to the bank, you tell them you want to buy a property. Let's say it's $10 million. Because you're in Jamaica, you can go to most working Jamaican citizens, taxpayers can benefit from the NHT benefit, which is a subsidized mortgage essentially for, as you said, like I think I don't remember the exact tiers. I don't remember if it is 6.5 million is the highest. I feel like they raised it recently, but maybe they raised it from 5 to 6.5. I don't remember. But basically, for the first whatever amount that is, so let's say 6.5. So for the first 6.5 million in mortgage that you get, you take out, depending on your income level, the interest rate will be whatever NHT charges, right? So if you're earning, I believe if you're earning like $7,000 a week, minimum wage, you get I think NHT actually has some 0% interest mortgages for that income bracket. So, but assuming that you're not earning that, and assuming that you are, you want not an NHT house, but a separate house that maybe it's like $15 million. So what would happen is that you would get the 6.5 million mortgage from NHT. You'd apply it to your overall mortgage. So if it's so to make the math easy, if it's a $50 million house, the bank will require 10, 15, 20% deposit. So let's assume it's a 20% deposit, a $15 million house. That means you have to come up with $3 million in equity that you have to put in. So you're mortgaging 12 million. Of the 12 million, NHT give you 6.5 at 4%. So you pay 4% on the 6.5 million, and then on 5.5, you would pay the whatever the bank charges, 8% or 9% over 30 years or over 20 years or whatever the term is.
Okay.
So that's at a high level, but Jilly is a much better person to dive into the nitty-gritty.
Just general info that we can keep in mind. And we have an advantage as young people, right? So the younger you are is the longer time you can get to pay back your mortgage, right? Is that good or bad?
so that is a hotly debated question, right? There are some people that, you know, they don't like a long mortgage because basically what it means is that you're paying more in interest. So even though the monthly payment will be lower because you're paying it over a longer period of time, ultimately, you know, at the end of the day, you end up paying more in interest. Personally, you know, I prefer a lower monthly payment. And again, that goes back to the whole optionality, you know, argument that we had earlier, which is if less of my monthly income is spent towards servicing my mortgage, then I can maximize the rest. I have more to maximize, right? So if I can put the difference to work at a higher rate than additional interest I'm paying, then it makes more sense for me to, you know, stretch it out even longer, right? But if all you're doing is just raffing with the additional money and you're just taking longer, then that don't make no sense, right? So that is that's the trade-off right there.
Great
Okay,
one,
and
man.
I think David dropped some videos on mortgages and mortgage fees and everything in the chat. So if anyone is a little bit more interested in mortgages, they can just check that out. So as young people and as students, insurance is kind of like in the back of our minds. We're not thinking about this at all. But do you think there's a benefit for young people to look into things like life insurance and health insurance at this point?
All right, I am probably gonna be crucified for this, but I'm gonna give you guys my God's honest, you know, opinion. So the truth is that insurance companies want as many young people as possible to sign up, right? And the reason is because, I mean, that is where their financial model makes sense. The more young people you have, because generally speaking, a young person doesn't have to claim, you know, have to make significant claims, right? Outside of acts of God or, you know, catastrophic incidents, the random catastrophic incident. So generally speaking, as a cohort, what the insurance companies would prefer is for all the young people to sign up so that you know, the older people can, you know, that have a higher payout rate, the entire pool is a lot more profitable, right? So if you're thinking about it from a societal perspective, then sure, you know, it is better for society, for everybody, if everybody signs up, right? So that's the context. That being said, you know, if you're thinking about you as an individual, and this actually called the tragedy of the commons, you know, it's like a theory where it's like, you know, what is usually good for the collective isn't always great for the individual. But so for you as an individual, the question that you have to ask yourself is, especially as a young person, what are the odds that I am going to need? So I'm going to ignore life insurance for now, right? Because life insurance, the real benefit accrues to your family, especially like your descendants, your kids and whatever, right? Like if you die, then they get a payout. So I'm going to just exclude that for now. So let's just focus on health insurance. The question that you need to ask yourself is, the only time that you really, so when health insurance really matters is when you have a significant health event, right? You either need surgery or, you know, whatever, like typically surgery or like chemotherapy or whatever, right? So, and to be honest, those things are events that you can't predict. So, and that is the benefit of health insurance, because you can't predict when this will happen, and it's better to have it than not have it. Because if you don't have it, it can bankrupt you, right? So that is the logic behind that. However, the question you have to ask yourself is, am I better off? So like, what are the odds? Or is it better for me to spend $100,000 to $150,000 a year, depending on, you know, your circumstances, the insurance company you go for, all of this stuff, right? Is it better for me to spend, you know, $100,000, $150,000 a year for 10 years for health insurance that I may never claim against, right? Or if you do, it's like dibby for like medicine occasionally, which you really and truly could pay out of pocket for. Or in the event, so is it better for me to do that, assuming that within that time year, that 10-year time period, I may need to make $1 million claim or a $5 million claim or whatever, right? If the answer, when you do the calculus and you say, okay, yes, I think that there is a risk that in the next 10, 15 years, I may need to make a $5 million claim. Therefore, it makes more sense for me to, spend 100, 150 grand a year. If you want to, the flip side is if you said, John, maybe I can set aside the money. Maybe I can invest the money and build up, $1 million, $2 million, $5 million, in like a health savings fund, and then dip into that if I need it, then, that could also be a strategy too, right? So I'm not saying that, I want to be clear. I'm not saying don't buy health insurance. I'm also not saying buy health insurance. I have bought health insurance for many years, and I have not bought health insurance for many years. I think the calculus changes significantly once you get married and have kids. That's a completely different thing because kids get sick, more frequently and whatever. So you can see more benefit then. But again, the one downside to not buying, or the major downside to not buying health insurance, is that you're always going to have on your head the notion or the risk of some catastrophic event. God forbid you're in a car accident or something significant like that you can't predict. Your health insurance may save your life and prevent you from going bankrupt. So those are my thoughts. Again, I'm not saying yes or no. I'm just giving you the way I think about it. So.
Okay, it's definitely a new view. Typically, when persons talk to us about insurance, they're like, "Yeah, get insurance now."
Right.
But I guess you're basically saying it depends on the type of person that you are and what you need in your life. So that's a very good.
And the risk that you are willing to take. I mean, some people may say, like, if you have the income, for example, and okay, yeah. So if you have the income, you're working in a good job, and your employer is willing to either partially subsidize your health insurance and life insurance, I would say absolutely do that, because the cash outlay that you have to spend every month is lower, right? So the benefit is the same, but the cash outlay is lower. So if you have that option, absolutely. But if you're self-employed, or you're an independent contractor or something, and you have to pay for everything out of pocket, and you're talking about $10,000-$15,000 a month, yeah, it can get a little sticky.
I actually didn't know health insurance was that expensive.
Yeah, it depends. It depends on
the person.
Yeah.
Existing conditions.
Was that David?
I was in existing conditions as well, because.
Oh yeah, exactly. If you have any existing conditions or whatever, yeah.
It depends on lots of different things.
Yeah.
So you mentioned that another strategy would be taking the premium and putting it into investments and see if you can build up a fund or so to if in the event of anything you can just take it out. So what investment strategies would you recommend for younger persons?
So I think the most important skill that young people should learn is how to analyze companies and investment opportunities generally, right? So understanding how to read financial statements, understanding the basic tenets of finance, just so that you can understand, like, for example, one of the things you don't want, I mean, I apologize in advance if I'm stepping on any toes, but the last thing you want to do is get stuck in some MLM, scheme where you have to be, selling. So whether it is a Forex thing or, Tupperware or, I don't know, gold chains or coffee, or I don't care. Like, you need to be able to have the skill set to be able to analyze world ventures. Exactly. You need to be able to growth mindset. Exactly. Them thing that, anytime anybody say, you want to make some money, like, and they might come talk about that, like, just run. Like, it don't, that them thing that, no, so anyways, so to me, I think that developing a skill set to be able to analyze things and to really think through, okay, how do companies make money? And, can this opportunity grow? Is this a good opportunity for me to invest in? That, I think, is the most important thing, right? Even more than any single, strategy, right? So that, I think, is the most important thing that will, help you off, help you, more significantly throughout your life.
You had mentioned analyzing companies, right? So I would take it that you're talking about equity, whether it's in a stock market or maybe even to join as a partner, but these are about businesses. I wanted to ask you if there are any other investment vehicles that you'd recommend for persons, and about their risk appetite too. You know, some persons are really tense about companies. There's something else that you think, or other things you think would be helpful.
Yeah. So for young people, definitely equities for sure. Equities meaning stocks. You know, so and again, it depends on what you want to do. I mean, if you want to be, you know, an active investor, like, you know, I heard that you guys were talking about the Siboney trade and all stuff like that. Yo, anybody would touch Siboney on a brave. Like, I don't have no time for none of that, right? Like, no, sir. That's just not my forte, right? Personally, what I prefer to do is I prefer to find solid companies that I believe in, that I will you know, kind of like build a position in over time. And then I invest in myself, and I invest in my own businesses and my own skills to be an entrepreneur. Because in my view, I think that it is, and this is actually, you know, as we can talk about this a little bit more later, but, you know, I think the expected return from entrepreneurship is higher than, you know, actively managing your own portfolio. That's just my view. That may be controversial, but that is, you know, that's my perspective. But yeah, so I would say for young people, equities, if you want to try and actively manage your portfolio, you have the time to keep up with everything and whatever, then knock yourself out. If you don't, then yeah, just find like, look at some unit trust products that invest in equities, you know, look for the best performing ones and, you know, invest it in there, and then focus on entrepreneurship or focus on climbing the ladder. You know, as a young person, what you want to do is you want to again, optionality, right? You want to optimize for a significant outcome, you know, whether it is, you know, via entrepreneurship or a significant increase in income by climbing your career ladder. So I would say those two things are where you should put most of your time, you know, one or the other, and then while also getting some exposure to the equity markets, you know, in some way, shape, or form. And you can do that easily by, you know, just analyzing a few companies that you like, you know, and just focus on those companies and just constantly invest in those companies over time, and just, you know, buy more and more and more of those companies that, you know, you believe are going to grow over time.
Okay, so Marc, speaking of equities and young people, we wanted to know what your stance on time in the market versus timing the market.
Malik, you want to get me in trouble? What a drama! What a drama! Haley, is Haley or Hallie? How do I pronounce it?
Hallie. It's Hallie. It's Hallie, like Halle Berry, yeah.
Okay, Miss Berry. What a drama. So what I would say is, so if you are a young person, yeah, again, it comes back to that same question, right? So what do you want to do? Do you want to actively manage your portfolio? Like, is that something that you enjoy? Is that is that where you think you can get the highest returns, as opposed to focusing on your career and focusing on and or building a business? You know, I think it really depends, you know, it depends on you. I think everybody should have exposure to the markets, and the longer that you have exposure to the markets is the better off you are. That is the whole time in the market argument, right? So like, for example, here's a classic example. Let us say, for instance, and again, I'm not advocating for any individual stock or whatever, but let us say that you focused on, you know, increasing your income, you know, in your career, and, you know, investing in yourself, and you're able to double, triple your income in 3 years, right? But at the same time, you know, in 2018, you realize you did analysis of the market, and you realize, oh, you know, there's some interesting companies. I'm going to buy 5 companies. And one of those companies at the time was Barita, for argument's sake, right? Whatever position you had put on Barita in 2018, you know, now it's up 10 times, right? Now you've done nothing else. Like, even if you have not added any more cash to your position, even if, you know, you haven't participated in any of the APOs or whatever, so you've been diluted on a fully diluted basis in that 3-year period, your funds have increased 10 times, and you've done nothing else, right? You focus on your career. So to me, that's just the classic example of, finding a solid company that you believe, has significant growth potential, getting exposure to that company, and then also, investing in your own thing. Because one of the downsides to the timing the market, argument is, along that run, the $9 to $90 run, there are a whole heap of times when you probably take profit and exit the position, right? And so, yeah, sure, maybe you come back in later and whatever, maybe you exit, you enter and whatever. But the point I'm making is that you're doing a lot more work, and then at the end of the day, you are limited with the amount of time that you have generally. So every second and every hour that you give to the markets, you are taking away from something else, right? Taking away from your career, or you're taking away from, building your own company, investing in yourself, pursuing entrepreneurship opportunities, all that stuff. So that's a trade-off that you have to make. Those are my views on that.
Okay. So I'm gonna allow Joshua Anderson to ask his questions on the mic.
Sure.
Yeah.
Oh, I was just asking, for me, the very, very, what would you say, inexperienced investor, normally I would go on like JMMB or Victoria Mutual and look at their evaluation of a specific stock, and based on their target price and their recommendation, I would make a purchase decision. Because I suppose, yes, I can get a basic understanding of the financial statements and whatsoever, but for me to say myself that I'm going to make a purchase decision is a little more iffy. So do you believe that those recommendations made by the brokerage houses are useful? Are they reliable? And what's in it for them? Because obviously these are posted for free and anybody can go and read them.
Yeah, no, that's a good question. I mean, it depends on. So, I mean, I wouldn't be able to make a blanket statement. To be honest, I've never done the complete analysis of every single recommendation by every single brokerage house, so I can't say that, right? I have taken note from time to time of recommendations by brokerage houses that have turned out really, really well. There are many brokerage houses, for example, going back to BIL, there are many brokerage houses that recommended, the investment of BIL after Cornerstone bought them, right? That if you had followed that advice, that would have been great. There are many brokerage houses that, recommended Mailpack as an example. If you took that advice at the time, either at IPO, shortly after IPO, the price is up, 300% since then, or almost 300%, if not more, since IPO. So, so I wouldn't say, and again, this is why I say it's important that you invest in yourself and you invest in your own knowledge and your own ability to do financial analysis. I think that a lot of those recommendations are a good starting point. I don't think you should take any as gospel, because, it depends. I mean, the truth is, at the end of the day, investment houses are filled with humans, and humans are fallible. They are busy. They're, as you said, they are giving this away for free. It's marketing essentially for them, based on research, but it is a marketing thing. Some of the picks work out, some of them don't. You need to know, and the truth is that some of them are suited for different clients. Right? There are some clients that, for example, put a higher premium on dividends, right? That may be interested, for example, in a Scotia play, this is pre-pandemic when, they had a relatively high dividend yield, not so much capital growth, but, they paid regular dividends. There are many institutions or wealthy people that put a premium on that and don't really, want the capital, or not don't want, but that's not their priority isn't necessarily capital appreciation. It's just return of capital via dividends, right? So whenever they publish their recommendations, they are publishing it to everybody, not just retail investors, but they're publishing to institutional investors also, right? So you have to take it with a grain of salt and be careful. So I would say don't take it as gospel, but don't dismiss it outright. Anybody that advocates for either of those is being disingenuous. And so that's why I say it's important that you do your own homework, understand, know how to do the analysis yourself, so you can take, you can take the information or the recommendations that they have as a starting point and look into the companies, right? So, okay, another thing that just came to mind recently, I mean, a while ago, and talking about this is going back to Barito. So before the recent run up in Carib cement, the price in, CCC over the last 12 months or so, Barito did recommend, to buy CCC, right? And that turned out well for those that bought at that time, right? So again, I'm not saying, so to take it with a grain of salt, make sure that you understand, you can do your own homework, and then those are my thoughts on that.
Okay, understood. Thank you.
No problem.
And we have a hand up from Renardo Wint. I hope I'm not butchering your name. You can go ahead and ask your question.
Okay, thank you. Good evening, everyone.
Oh, go on, Renardo.
I joined the meeting pretty much late. I don't know if you guys covered this before, but what advice would you give to like students that are working or pretty much really and truly don't have much time to be on the stock market that much? And you understand, to understand and get the basic ins and outs. I'm not sure investor. Let me use myself for example. Started investing like 1.5, 2 years ago. But as I said, busy with work, school, everything. So I don't get the chance to sit down and get the ins and outs and the nitty gritty of things as regards to stock and things. And I invested, then I came back and look at the stocks and they plunged down, and obviously gonna feel some type of way. So I'm saying, okay, what advice would you give to investors like me that having that problem to avoid this type of situation?
So a great question, Renardo. So that is exactly why, I said what I said earlier, which is, I think the most important skill for you, Renardo, and anybody else in your situation that is busy, the most important skill that you should learn is not necessarily how to do short-term trades and technical analysis and all that stuff. It is, how do you analyze companies and understand and make a decision about whether or not I believe or you believe that this company is going to grow over the short, medium, and long term, right? Once you can go through that process and acknowledge and realize and identify companies that are solid, that you believe will grow, you don't need to pay attention to it every single day, every single week. You can check in every quarter. Every time they publish quarterly results, you check in and say, what's going on? You pay attention to the news. Are there any significant developments? Did a key person, does this company rely on a key person? Did that key person resign? If a company is built around one single, key person and the person resigns, that could present an existential risk to the company. So even though they may have been growing significantly the last 3 or 4 years, when you see the headlines at Gleaner or whatever that they have resigned, even though you haven't been watching it every single day, you should know that, okay, I need to pay attention. Either I'm going to exit or reduce my position or just watch it. You know what I mean? So the point I'm making is that once you, I think personally, I think young people are much better off served learning those skills to be able to analyze a company and make solid medium-term and long-term bets, check in regularly, but focus on their career and entrepreneurship. That is my general thing, as opposed to focusing on actively trying to trade your portfolio. That's my perspective.
Okay.
Okay, thank you very much.
Yeah, man.
So we know that you started your own business, TCP things. How was that experience of starting that business?
All right. So that, I mean, it's been tough. So TCP was actually started by my two co-founders, and my two partners. They had an idea for making some Jamaican greeting cards and tote bags, and they came to me for advice, and I was just like, guys, this don't make no sense. Who the hell buys greeting cards, and who wants the tote bag and whatever? I mean, I guess I am not the target market. So I genuinely couldn't see that's like one bag of things and a tote bag. Who the hell would want that? That don't make no sense. But obviously I don't carry tote bags, so I couldn't see it. anyway, thankfully for me, they ignored my feedback and advice initially because I'm just thinking, tech, you wanted the e-cards, all this stuff. And then what they did is that they just designed, they made a few prototypes and then they went to a show called Moda. This was in 2017. I got a table. And then within that first weekend, they sold off like 2 or 3 times. They had to do 2 or 3 more reprints during the weekend. So one of the things that I do is I have learned not to ignore feedback from the market, right? And so, the fact that, the market demand was so strong that they sold out, that tells me that, there's something here. So after that happened, we reconnected again, probably like a month later. And then I joined the company. And then since then, I have just been working with them and we've been building it out. It has been tough. It's been rewarding, but it's also tough. Like, entrepreneurship is not easy. Like, it's not all, a bed of roses. In our case, like some of the most, I guess, rewarding things for me are when people, see my products and interact with them. They're laughing. Like if I walk into a pharmacy and I hear a bunch of people laughing, typically I know that they're at my greeting card stand, right? And like that's a very, very good feeling to have, and I absolutely love that. So there are some tangible stuff that, you can't really put a price on. But other than that, it is, it's been good, but it has been tough at times, so it's building a business generally is not easy. Building a business in Jamaica is even worse. Like, it is very, very difficult. But, outside of that, I have, started other businesses too. And, and so entrepreneurship is not easy. So I don't want to, I'm not trying to sell it as, once you become an entrepreneur, you're going to become a billionaire, right? It don't work like that, right? But, the expected outcome is a lot higher there than anything else. So.
I like how you said the expected outcome is higher because I would think the potential, right? Like entrepreneurship, it's kind of on this distribution where you have some hyper successful people and a lot of failures very quickly. They think that all those zeros make the expected, like the average low. So why would you say expected? Like the benefits that one gets, even if it's not financial, do you think it's more worthwhile money and aside from that to be an entrepreneur than an active investor on the JSE if you had to compare the two instead of saying, oh, just do both?
Yeah, okay. So I'm happy you asked that question because I do think so. I think that so it's all about math, right? So when I said expected outcome, what I really meant is the distribution of outcomes, especially, so it is kind of like a like a bell curve where most of the outcomes are in the middle or, are average. But the tails, specifically the higher end, so the right side of the tail or whatever, the outcomes are so much larger that it actually pulls the average up, right? Just as an extreme example, it's insane to me that we are living in a time when we are likely to see our first trillionaire. Like Elon Musk is likely to become the first trillionaire ever in history, and it's going to be in our lifetime, right? Like once SpaceX goes public, it's like game over where that's concerned. It's almost a shoo-in. It's just a matter of time, maybe like 15, 20 years, that is likely to happen, assuming he doesn't die, assuming nothing catastrophic, happens between now and then. That being said, it is all about math. So let's just say, for argument's sake, your goal is, you want to accumulate $100 million Jamaican, right? So the question then becomes, how do you do that? Do you, actively invest, or do you, pursue, entrepreneurship? So if you actively invest, and let us say that we're talking about a 10-year period. Let us say that you're starting off with $10,000, just to make the math simple. To turn $10,000 Jamaican into $100 million without, investing any additional thing. And I know, I get it. You probably would likely invest more over time. But just to keep the scenario simple and clean, to do that, you have to analyze a compounded annual growth rate of about 151%, right? Now, the question is, can the average person produce a compounded annual growth rate of 151% every single year for 10 years? Not likely. Not likely. What is more than likely to happen is there are going to be some years that are bad. Some years you're going to lose money. There are going to be some years that you only do 20%, 30%, and then also there are going to be some years. So let us say, for argument's sake, for the first 5 years, you are very successful. And again, I'm talking within the JC context, right? As your portfolio gets bigger, it gets harder to generate returns because there are fewer trades. There are fewer, it's harder to do larger transactions because the JC is very illiquid, so it's completely different putting in a $50,000 order than it is putting in a, $5 million order. It's night and day, right? So that's that. So that is on the investing side. On the entrepreneurship side, there are a million different ways that you can get to that $100 million, but I'm just gonna focus on two. One is, let us say that you want to build a company that you ultimately list in 10 years, right? List on the stock exchange. So to do that, so let us say, for argument's sake, you want to have a $1 billion Jamaican net worth. To get a $1 billion Jamaican net worth, assuming that you would raise money along the way, and so therefore when you IPO, you would own 30% of the company, you would need to have a $3 billion valuation, right? In order for you to be a Jamaican billionaire, you would need to have a $3 billion valuation. Well, if you look at the multiples of what the junior stock exchange trades at, it ranges, this is pre-COVID, it ranges anywhere from 18 to 25 times earnings, right? No, it's more on the lower end. But let us say, for the simplicity of math, let us say it's 20 times earnings, right? So to get a $3 billion valuation listed on the junior stock exchange, you need to build a company that is generating $150 million Jamaican in net profit. That's what it boils down to. You need to build a company that generates $150 million net profit that you own at least 30% at listing, right? That's the way that math works. So the question is, can you build a company that's generating $150 million in net profits in 10 years? I would say that, I think it's a lot easier than people think. It's not easy, but it is easier than people think, right? So that is one angle. The second angle is, let us say that you want to, another angle is that you can either, well, actually, I wasn't going to mention this, but okay, so it's three things. The second angle is you can build a SaaS, software as a service product or company. And software as a service is just, some software that you build that people, people pay on a monthly basis for, right? Within the last maybe like 2 or 3 years, there has been this a surge in popularity of people buying and selling SaaS companies, on the internet, right? And so if you were to build a SaaS company that does $30,000 a month, right, that works out to about $360,000 a year, you can sell it for 3 times annual recurring revenue. That's $1 million. That's $1 million cash in your pocket. So if you can build a SaaS that does $30,000 a month US, you can literally sell it for $1 million US, straight cash in your pocket. Right. So that's the way that math works out. $30,000 a month is just charging. You just have to find 600 customers to pay you $50 a month. Right. Or you find 300 customers that pay you $100 a month. So the question is, can you take 10 years? No, you don't have to, you don't have to hit $30,000 a month in month 1. You can hit $30,000 a month in, month 1 of year 10. So the question is, can you take 10 years to build a software as a service company to a place where you are doing $30,000 a month? I think so. I think it is very, very, feasible and realistic. So those are the two paths. Another path is, let us say, you want to, software as a service is one thing, but the math also works out for many other different types of things. So let's say you want to, develop, you can build themes, for example, for websites, and you sell them on, marketplaces. You sell them on, Code Canyon, Envato, marketplaces. You sell them on, template websites. You sell them on, all these places. There are a bunch of theme creators that are making, 10, 15, 20, $100,000 a month. And they're all over the world. They're in Indonesia. There are a bunch in Jamaica, so it's not, so even if you did the exact same thing, the math kind of works out similarly. If you build a theme or a template, selling company, for example, that's doing, $30,000 a month in net profit, which is, again, is also possible over 10 years. You could sell it for $1 million, right? So, so those are, I guess, 3 ways in entrepreneurship that if you want to get to, $100 million Jamaican, well, in that case, in all those cases are listed there at 150, but yeah, the math is similar. But I think that is, it's a lot more possible than you think.
Okay. Well, that was very, very informative. But we have one last question. I know you have to leave at 5, but we wanted to know like a brief overview of what is the golden window.
Right. Okay. So the golden window is a theory that I kind of came up with that basically says that every single country goes through a period, or not every single, some countries go through a period of time where they develop very, very quickly, and or rather, develop at a higher rate than they have historically, and a lot of wealth is generated for a big chunk of the population. So we saw it there are many examples of this. America after World War II, for example, is one classic case. Germany after World War II is another example. China after 1980. India, and there are other examples. So my theory is that any country that gets certain macroeconomic conditions correct and right can enter this golden window. And I personally believe that Jamaica entered her golden window probably about maybe like 2 years before the pandemic. I mean, the pandemic definitely, slowed it down. But I definitely do. I think that, we're still in the golden window, and assuming that, policymakers don't make any bad decisions, we can potentially stay in there. So what that means is that a lot of people can make a lot of money over the next, maybe like 10, 15, 20 years, maybe 25 years. But there are no guarantees. It is our job as young people to, pay attention to what's happening, to keep our, to hold our policymakers to account, make sure that they pursue prudent fiscal policies. They don't, just spend crazily, and, no run with it foolishness that, happened in the past. And, we just pursue prudent fiscal policies. Like once you do that, then, and we continue to do that, then I think that, we'll be fine, and Jamaica will change. So if we are truly in the golden window, then Jamaica in 20 years is going to look extremely different than Jamaica today. Like it will be a second world country, if not like starting to be a first world country.
I really like that. That's optimistic. Mr. Marc Gale, I know we've asked you to overstay how long you have a meeting, but we would love to thank you on behalf of both the UWIC and the UWI Rotaract Club for taking the time to share your insights and the wisdom you've collected over the years with us.
Yeah, man. So thank you for having me. As I said, I'm very happy to see you guys doing this stuff and paying attention to these, taking it, seriously. I can imagine that we're, I'm seeing probably, future business leaders and wealth creators, in this club, which is awesome. So if anybody builds, a SaaS company or any company that's doing, $10,000 in profits a month, and you want to figure out how to, sell it, you can always, DM me, contact me. I can help you with that.
Okay. So it was an incredible conversation. Thanks again. Wonderful meeting. We're gonna just keep on for any announcements. So, and any additional questions, you don't have to stay. So if anyone has any questions, you can just
send on Marc on Twitter.
Yeah, you can follow me on
Yeah.
Twitter. LinkedIn, I'm not, I mean, I have a LinkedIn profile, but I don't really use it, to be honest. So I would say that probably is not the best platform. Twitter is fine, and you can my DMs are open, so you can DM me. I'm at Marc Gale on Twitter. If anybody has any questions, I can, answer them really quickly. Any additional questions?
Okay, Marc, someone had a question earlier. I think it was Odain. He was asking, on the note of inflation, how do we sense when it's a threat?
How do we sense when it's a threat?
Yeah, that was Odain's question.
Yeah. Okay. So inflation has been one of the biggest threats to Jamaica's economic development over the last maybe like 25, 30 years. In the last 10 years, we've tamed it, and it has been in a reasonable range. So Ministry of Finance set the range of 4 to 6%, and that's what BOJ's target is. So once it's within the range of 4 to 6%, we're fine. But of late, it has been trending up. It recently, it broke out, 7.1% a couple of months ago, and then the last report we got, it was at 8.2%. So right now, it is a threat, which is why BOJ has, they have raised interest rates. They have taken an aggressive stance to try and tame inflation, because inflation is the biggest risk to, our overall economic program. So yeah, I mean, the only thing we can do is just basically watch it and watch, what BOJ is doing, and how they are combating. But that being said, they have the tools. They have enough reserves, and reserves are very, very healthy. They're independent, so they don't need to, make any decisions that are politically expedient. In other words, that are good for the government. They can make decisions that are good for the country in terms of inflation, which is a good thing.
In hindsight, it's pretty good what the governor did with raising the policy rates since seeing the new inflation level.
Ask about that too.
Yeah.
What do you think about it being raised by 100 basis points? Some people were worried about loans that you already have, like variable loans, but then again, we need to control inflation because it's so high right now. So what's your take on that?
Yeah, I mean, so it comes at a cost, so it's not free. The cost is that it's going to slow down economic growth, and the main complaint that people have, which is a valid criticism, is that our growth has always been anemic. So anything that's done to slow it, is not really, it's an issue. The problem, though, is that as much as growth has been anemic, what is even worse is endemic sustained high inflation. It is very, very difficult to tame high inflation, extremely difficult, right? Like America went through it in I think it's the 70s, and Paul Volcker, he was the Treasury Secretary or the Fed at the time, the Fed chairman at the time. I don't remember which one. And he committed to breaking the back of inflation, and it was brutal, absolutely brutal. The measures that he had to make, raise interest rate. Yeah, I think he was the Fed chairman. He had to raise interest rates to some crazy levels, and so you don't really want to get there, because as bad as things are now, in terms people are ball for 100 basis point increase. Like if they have to do a 500 basis, I mean, God forbid that should ever happen. I mean, but if they ever have to do that at them time, that the economy is just screwed. So what BOJ was basically saying is, we see the fact that people are expecting. So what they were really concerned about is this thing called inflation expectations, which is a survey that they do among business people, which set prices. They do a survey on a regular basis to say, okay, why do you think that, or rather, what do you think inflation is going to be over the next 12 months? And this is a regular survey that they conduct on a regular basis. And over time, it has been trending up. And in July or whenever it is that they did it before they raised rates, they expected, the inflation expectations were 7.odd%. And that was when the reported inflation was like 5.20%, or 6%. It wasn't even 7% or 8%. So what they were concerned about is business people that set prices would expect that inflation is going to skyrocket. And so when they expect inflation is going to skyrocket, the rational response is, I am going to raise prices to get ahead of it, right? But then when they raise prices to get ahead of it, it creates a self-fulfilling cycle, right? Because they then raise prices, their competitors then raise prices. Sure, that boosts revenue. When that boosts revenue, in the short term, they need to hire more people. When they hire more people, the labor market contracts. When the labor market contracts, wages increase. When wages increase, aggregate demand, so demand throughout the entire economy increases. And when that happens, inflation increases, right? So just by business people and price setters expecting prices to increase, just by trying to get ahead of it and raise prices, that could set off a cycle that is extremely difficult to reverse. Because obviously, once revenues increase and wages, they start to hire more people, I mean, the only way to roll it back is to fire those people and reduce wages. And nobody wants to do that, right? So BOJ was basically saying, listen, inflation expectations, they are high now and they are a real threat to the inflation program. So we are going to get ahead of it and we are going to shock the market. Everybody expected some form of rate increase because they did project that we are going to raise rates. But the general consensus was that, maybe it was like at 0.25% or 25 basis points or 0.5% at the most. But they went straight to the 1% or the 100 basis points. And that was because they're trying to send a signal to the market. Listen, we are going to get a hand on inflation, so do not raise prices. That's the whole point behind, why they did what they did.
Thanks, Mark. I think you're so right about that. And it's facts. I really agree with you. And if you think about it, I don't know if you heard about Zimbabwe, for example. So I saw this picture. I don't know if any of you guys were in Dr. King's class when he showed that picture of a sign in Zimbabwe that said, don't flush notes, meaning money, down the toilet, because tissue paper is more valuable than their currency. They literally had like a $1 trillion bill or something. So if inflation runs away, that's what can happen, which is insane.
Exactly.
Venezuela.
Exactly. Malik just pointed it out. Venezuela is the same thing. I mean, Venezuela is a different case, but yeah, inflation is high. Inflation is hard. That being said, low inflation or deflation is also equally hard to break. And you can just ask Japan. Japan has been dealing with deflation for a while.
Yeah.
So it is.
Very true.
Yeah, the best case scenario is a healthy range, and for Jamaica, they have determined that it's 4 to 6%, and so BOJ is just trying to get it back to the 4 to 6%. So don't panic. I mean, it is higher than the range, but there's no need to panic right now.
Okay, thank you so much, Mark, and thank you for staying overtime to answer our questions. Really appreciate it.
Yeah, man, no problem. Thank you for having me.
Yeah.
Thank you so much for being here, Mark. We learned so much from you, gained so much insight and knowledge of financial literacy. So thank you so much for your time on behalf of the U Young Investors Club and the Rotaract. Would Rotaract like to say anything?
My sentiments would be repeated. Exactly, we've learned so much, especially for us who need to have a basic understanding of financial literacy. So yeah, thank you.
No problem. I appreciate the opportunity to share, and yeah, just keep on keeping on, guys. You're on a good path.
Okay,
I'm gonna jump off now, so may I do this another time later.
All right,
take care.
Yeah, man, later.
Bye.
Okay, guys, and if you'd like to officially sign off with YIC, I think some of you may already be a part of us or not. We're gonna send the link to the form in the chat, so you can officially sign off, and you should get a welcome letter by the end of the week, so that you can join our official WhatsApp group. You can get all the info. You'll be on our mailing list. Yeah.
And Joshua, I think you can probably resend your attendance form in case some person didn't see it in the chat, and just give probably like 2 minutes or 3 minutes before we end the meeting.
All right, no problem. I see it there. It's popped up again.
Are there any announcements that you need to make for Rotaract?
No, I think I said what I needed to say before. So
okay, I think David was saying something.
I was gonna say we can spend a couple minutes just discussing some other things in terms of what was discussed.
Okay, sure.
No, because I was gonna actually drop in at some point about how using debt responsibly does come in handy. So I was gonna discuss how, for example, a credit card. It's one of the easiest routes to build credit, unless you have a parent who is gonna get a credit card in their name and put your name on it, and let's use the card as you please. But you get what I'm saying?
Yeah.
And the thing is, it's basically an extra cash flow source. So if you're getting paid on the 25th and your due date, your balance is the 15th, for example, then you can basically, travel around and choose how you want to play with your credit card. But at the same time, it's actually cash flow source. You can optimize the cash flow better. So instead of paying off one particular install at once, you can spread it out to a longer time frame. At the same time, once you're paying a credit card on time, it's basically just free rewards and better opportunities. Because once your card gets trapped, it's the bank's money. If the debit card gets trapped, it's your money on the hook. And if your credit card gets trapped, you just request a new one. If your debit card gets trapped, you request a new one, but your money kind of tied up in the meantime. And the thing is, most of the persons who pay, so the credit card rewards you get are really paid for by the persons who mismanage their credit card. So the persons who, are going to Dream Weekend, KFC, and all those other places using the credit card like there's no tomorrow. Yeah, they technically pay for our rewards by being bad financial managers. I was going to explain that if you guys haven't heard about margin loans, that's another way to actually unlock value from your portfolio. So let's just say, for example, you are a long-term investor. You can just, take out a margin loan to access capital. Say you see an opportunity, you have an emergency or whatever, you can use that opportunity or gateway instead of having to call the bank and go through the entire loan process. Like, yeah, that's another route you can use.
Nice. Anybody else have anything else they wanted to add?
Sounds like about it.
Yeah, it sounds good.
Okay. It's been a great meeting, guys. Thank you all so much for coming out. Thanks for being here. If you've been here from the start, thank you for coming out every week, and we hope to continue seeing you. If you're new, welcome. We're so happy to have you a part of our growing community. As you saw, we were up to like 78 participants today, which is incredible, guys. We've been growing so much together, and it's a beautiful thing. We can share our knowledge with each other and just enrich ourselves with information about investing and financial literacy and so many things that are good for us in life. So thank you all for being here. Have a great rest of your week. Stay safe. And happy investing. So we'll see you guys next week.
Excuse me, Victoria.
Oh, okay.
Before you go, I signed up the membership sheet and everything, expecting my email and everything, but I didn't get the follow-up email to actually become a member.
Okay, when did you send your when did you sign up?
Probably like 2 weeks now.
Okay, I'll check on it for. Oh, really? Okay, I'll check on it for you. You can just DM me your email address and I'll get it checked for you. Sometimes what happens is that the emails go to your promotions. So if you guys have a lot of mail, you might miss
promotional
it.
emails, as in regards to the meeting and what you guys covered in the meeting normally come to my promotion, they'll come to my inbox. So yeah.
Oh well, if you're getting promotional emails from us, then you should have gotten the welcome letter. But I'll check on it for you. But just in general, guys, if you sign up and you don't see it by the end of the week, check your promotional emails or spam. Or if you sign up with your UWI email, you might forget because UWI sends so many emails. So just double check and see where it's at. But if you're not seeing it, just send me a DM and I'll check on it for you, no problem.
Renata, just to help there, if it's going to your promotion tab, maybe you could change the tab to inbox, like emails from YIC. You can also do something like that just to make sure it doesn't happen again.
Yeah, man, no problem, Ali.
Yeah.
Okay, well, I think that's it. If you guys have any other questions or anything, you can just contact us in the chat or any of the exec members. We're here for you guys. So yeah.
And thank you for coming out, Rotaract members. It was lovely having you guys. I hope that you guys actually learned something from this meeting, because I think that was a very good guest speaker. So I'm hoping that you guys actually absorbed something. And if you guys at Rotaract have any questions in regards to any of the topics that we spoke about today, we are always, available to answer anything. So you can probably talk to Nemishi or Joshua with any questions you have, and we'll be willing to help you out. So.
And even if you guys want some resources that we have, like, where we link stuff in the chat, there's a lot where that came from. So, they're freely available. If you want to know more about, okay, how do I know what basis points are, or how do I learn to read a financial statement? The information is out there for free. You don't have to pay a soul to learn it, and we can help you find it. So even if you don't want to talk to us, like, get an explanation, if you just want to know what vids to watch or what to read, reach out.
Yeah. So you guys can actually follow us on Instagram. Can Matty just drop the @ in the chat? So in our link in bio, we have the Kalila Reynolds stock brokerage guide that will help you if you're actually interested in starting investing. You can look at that and you'll be able to kind of see which brokers to go towards depending on your situation. And we also link any relevant stuff there. And we have a weekly news post, which is one of our most important segments. So that is just a very good thing to keep an eye on. So you guys can count. Any announcements from Rotaract? Do you want any persons on your services? Do you want additional service members? I don't think. Okay, I'm taking it as a no. So great meeting, guys. Thank you all for coming out. I'm going to end the meeting now. So bye-bye.
Bye, guys.
All right. Bye, guys.